Welcome to How to Retire on Time, a show that answers your questions about all things retirement. My name is Mike Decker. I'm a licensed financial advisor who can even file your taxes. Now, that said, please remember this is just a show. I'm not giving you financial advice. Everything you hear should be considered, informational. With me is my esteemed colleague, Mr. David Franson. David, thanks for being here.
Yep, glad to be here.
David's going to read your questions, and I'm going to do my best to answer them. You can text your questions in right now to 913-363-1234. That number one more time, 913-363-1234. Let's dive in.
Hey, Mike, how can an annuity offer a guaranteed withdrawal rate of 6.5% when we are told you should only take out 4% from your portfolio?
This is like stepping into a viper's nest or something. What a loaded question. So it's loaded on a couple of levels. First off, the 4% rule is a rule of thumb. It's not exactly what a withdrawal rate is. And if you go to the financial conferences, which I'm sure everyone here is just gearing up, you got the Met Gala, you got the Grammys, and you have the local financial conference, right? Equal excitement.
Absolutely. Lots of paparazzi at those financial conferences.
It's a very highly debated topic of what the correct withdrawal rate is. Now, that said, the insurance company is not a charity. They're not smarter than the whole industry of the broker dealers, the hedge fund managers. So the whole question, it's like saying, why do apples not taste like oranges? So let's slow this down and really pick it apart step by step. Okay.
Sounds good.
Which one do you want to start with? The 4% rule or this 6.5% withdrawal rate?
Let's start out with that rule of thumb, 4% rule.
Okay. So the 4% rule, which was invented by William Bengen and is a well-tested, documented, peer-reviewed concept that says if you invest in a 60-40 stock bond fund portfolio, which I'm not saying you should do, I'm just saying that's kind of what the study was built around, that your stock should average 8-9% year over year, doesn't always. And then your bond funds, I'd say 4 or 5%, I think would be reasonable over a long-term study here, that you should be able to draw 4% and be fine. Now, the idea was, and I'm paraphrasing here, that markets go up and down, and that's expected. But if you're drawing less than it's growing, then you should be able to withstand some of the market crashes. Should is the key word here. It should give you a good idea of how much you need to save. Should, again, be the key word here. Should give you a realistic income target. Should being the key word here.
Noticing a theme there, yeah.
Some repetition will do us all well. But it was a rule of thumb. The problem with the 4% rule is something called sequence of returns risk.
Explain that.
Yeah. So sequence of returns risk, the idea is that the sequence of the return matters. So when you're investing in the market, when the markets go down, it's to your advantage. Anyone that's 50 years or younger should want the markets to tank, to just be mayhem.
Okay.
So they can buy into it cheaper and then it recovers.
Okay.
It's like, everything goes on sale. It's not like a business is putting everything on sale saying, yeah, let's make less money. Like there's a reason why businesses do sale anyway. So that's called dollar cost averaging. It's to your advantage. But when the flow of money reverses, it's not dollar cost averaging. It's called sequence of returns risk. So here's why. If you draw income from an account that's made money, it's not that big of a deal. But if you draw income from an account that's lost money, it is a big deal. You're accentuating the loss, making it more difficult to recover. Here's the simple math. If you lose 10% in your accounts, it takes 11% of growth to break even. Not the end of the world. If you lose 30% in your accounts, which historically happens every 7 or 8 years, that would take a 43% return to break even. Now, if you lose 30% and you take out 4%, because that's the 4% rule, you need to pay your bills, you need to live your life, you're now down 34%. That means you would need a 50% return to break even. That could take 4 or 5 years. No one knows the future. So you can see where this timing the market, the sequence of the return matters. Oh, well, Mike, it's okay. Overall, the average is 6%. Averages are deceptive. And this is why it's meant to be a rule of thumb, not an actual withdrawal strategy.
Sure.
So averages are deceptive because let's say you expect a 10% average.
Okay.
So $100,000 with a 10% average. Over the first year, you'd have $110,000. In the second year, you'd have $121,000. You see how it progressed there, 10% growth each year on
Sure.
average? Well, let's say the markets went down 30% in year one. Your 100,000 is now 70,000. But let's say then the markets recovered. And let's say they really recovered fast. Let's say they had a 50% return.
Ooh, yeah.
Okay, now it's a 10% average, which I
Okay.
can't remember any time that's ever happened. But for argument's sake, let's say it did happen. You would now be up at 105,000 with your cash value. 10% average, but really the return on your cash is what, 2.5% year over year? Very different. So when you're looking at your withdrawal rate, withdrawal strategy, taking money out of accounts that has lost money accentuates the loss, making it more difficult to recover. That's why sequence of return risk is a big deal.
Mm-hmm.
So the idea behind the 4% rule is you can focus on growth, you can have flexibility, but you just got to understand that if the markets go down, you might need to tighten things up. It could be difficult. You're basically trying to time the market, healthcare costs, whatever reason you need to spend your money, right?
Right.
And hope that it's not during a market crash, or hope that your market crash is when you retire is like 7, 8, 9 years away from when you retired. So you had enough growth to then handle it. But if the markets crash the first or second or third year of your retirement, you could be tripping up for the rest of your life. You may never fully recover.
Yes, I gotcha.
Okay, so that's the 4% rule, and it scares the bejesus out of people. It scares them so much that then people panic, in my opinion, and they'll buy the annuitized income. What's that? That's this promised 6.5%.
Uh-huh.
And from an argument standpoint, would you rather get 4% for the rest of your life or 6.5% in guaranteed? And there's so many manipulative sales pitches, dinner seminars that just go through this over and over again. Let me explain what you're not hearing.
Okay. Yeah, we'd love that.
If all things were equal and you could guarantee a 6.5% return for the rest of your life, that's the easy thing to do. It's not. 6.5% from what I have seen, and those rates can change. We're not quoting any specific product here. It's an advertisement that I have seen go around on someone's LinkedIn post that I'll just leave it there.
Yeah.
And my sentiment towards that. But the oversimplification's out there. Basically, that's a flat income stream. There's no cost of living adjustment. So you could have 6.5% of your $1 million and have that income for the rest of your life. But inflation's going to erode it over time. So if you compare, let's say, a 4% income that's growing and the balance is growing at a reasonable rate adjusted for inflation, and compare the cash value, the spendable income, your buying power, and compare that to a flat income that starts higher, but after 10 to 12 years, inflation would have, on average, based on that 3% inflationary rate, eroded to the point where you have less money to spend than the 4% rule. The break even is, based on my calculations, after 10 to 12 years.
I mean, that doesn't sound good, does it?
When do you want the purchase power squeeze to happen? In your 80s? When you're not going back to work? When your health is declining?
Right.
I mean, it's a huge deal. And we forget about these things because for the last, since 2010, we've had virtually no inflation. And then all of a sudden it spiked.
Right.
So we need to have more holistic, more comprehensive conversations about what are you actually signing up for? Because 6.5% flat income, in my opinion, is dangerous if you live a long time. And if you don't, probably wasn't that financially advantageous either because the cash value may not have grown that well. So you've got to look at what's under the hood. How is inflation going to erode it? Now let's talk about inflation today. Do you feel some inflation over the past couple of years? Since the pandemic?
We might have noticed a little bit, yeah.
Yeah.
Grocery bills a little bit higher, other goods higher than they were.
Everything's gone up.
Yes.
So you could say roughly 30% of our money's been inflated away. We really felt it, okay? Let's go to the annuity for a second. Anyone that would have signed up for a flat income stream, let's say in 2019, just lost 30% of their lifetime income, roughly speaking, because inflation got out of control and their income was fixed. That's a danger. Now let's look at, I'm going to get political for a second. You mind if I get political?
Well, it's your show.
That's true. No one owns us. We could say whatever we want as long as it's legal, honest, research backed, and ethical. And we can say it.
Okay.
It's a good standard.
Then let's do it.
So in the late 60s, early 70s, inflation got out of control. They increased interest rates. They made money expensive again, and they brought inflation back down. And they said, oh, inflation's trending down. We fixed it. Then they lowered rates, which they did too soon. And then inflation spiked back up. I mean, over 10% in 1 year. It was horrible. And then they jacked up interest rates because they're trying to make money more expensive to try and hurt the economy because the economy got out of hand and inflation got out of hand. So that's what you do when that happens. And then inflation started coming back down again. And they said, all right, well, we've solved it this time. It's going down fast enough, but we don't want to hurt our economy too much. So then they lowered interest rates too soon for a second time. And then what happens? Inflation got out of control again. And then one of my economic heroes, Paul Volcker, the cigar smoking chairman, got in there and he cranked up interest rates so high. I mean, where it really hurt the economy. But it's like physical therapy hurt, like the good kind of hurt.
I know exactly what you're talking about.
You go to the massage therapist, they give you a deep tissue massage, the good kind of hurt, okay?
Right.
Whether people like it or not, it's what we needed. He brought interest rates back into parity and under control, which led to a very healthy economic boom in the 90s. I thank Paul Volcker for that. So all of that said, if you look at those charts and you look at what's going on today, there's a reason why Fed Chair Jerome Powell is probably not eager to lower interest rates too soon. Just look at corporate profits. They're at record highs right now. The economy could go gangbusters, especially if he dropped rates. And what would happen? High risk of inflation getting out of hand. Now, maybe it doesn't, maybe it does, but I understand why he's holding out on interest rates and why he's keeping things where they are. It's not politics, it's history. And I can argue for him. Now, should he and for other arguments? There's a lot of arguments made with economics. That's why it's theoretical, kind of. The point being is inflation can come or could come roaring back if Trump flinches, if the tariffs don't work out as he plans, if Jerome Powell cuts rates too soon, if the dollar weakens too soon, or there are so many reasons. So we are walking along a very thin line here with inflation. So if you're signing up for a flat income stream, though it sounds appealing at 6.5%, understand the risk that you're taking. It may work out to your benefit. It may not. Everything has benefits and detriments. There's no such thing as a perfect investment product or strategy. Nothing does everything well. And insurance companies are not charities. They're not giving you more money out of the goodness of their heart. That's not to vilify any insurance company. It's that I believe their products are not being properly and correctly defined, identified, and explained to people.
All right.
So we need to understand.
Yeah. And what do you always say about insurance that's not an investment?
More specifically, life insurance is not investment, but even annuity, you could argue that too, because an annuity typically is associated, based on my experience, with an index that's not very competitive. Now, there are some annuities that have a competitive cash value growth aspect, but their income stinks. People don't talk to them about them as much. But you've got these annuities that offer competitive growth, but they've baked in when they expect you to pass. The cash value should be done within a reasonable time so that the odds are in the insurance company's favor. And there's nothing wrong with that as long as we correctly define that. You've transferred longevity risk to an insurance company. That's what you've done. This idea that you can get a better withdrawal rate, it's not a withdrawal rate. The 4% rule, 4% is growing based on your assets growing.
Right.
There's a cost of living adjustment or provision baked into there to help you keep up with inflation. You can buy an annuity with a cost of living adjustment, so guaranteed income for life, but you're not starting at 6.5%. You might start at 5 or 4%. Interesting how we got back to 4% there. You might buy an indexed income increase so that if the markets go up, your income increases. But again, it's not guaranteed. There's some nuance with that and what indexes is it associated with, and when does that benefit stop? Because it typically stops after the cash value hits zero. There's more going on here than meets the eye. You need to understand the benefits and the detriments, because the second you think you're getting a good deal or an exception to the rule, there's something you're missing. I cannot emphatically say that enough. I know many people that have purchased a flat income stream and a cost of living adjustment income stream, so based on an index, and that covered their basics. So, the basic expenses of life and then they blended other assets for other income sources, whether it's privately traded REITs, whether it's just income from the growth or a dividend strategy or the rental income. I mean, there's so many things you could blend in. I could see that making sense in those situations. But all in all, be aware of what you're doing. Ask questions. These things matter. That's all the time we've got for the show today. If you enjoyed the show, consider subscribing to it wherever you get your podcasts. Just search for How to Retire on Time. Discover if your portfolio is built to weather flat market cycles or if you're missing tax minimization opportunities that you may not even know exist. Explore strategies that may be able to help you lower your overall risk while potentially increasing your overall growth and lifestyle flexibility. This is not your ordinary financial analysis. Learn more about Your Wealth Analysis and what it could do for you regardless of your age, asset, or target retirement date. Go to www.yourwealthanalysis.com today to learn more and get started.